Hello everyone. Welcome to Tread One Journeys. 1. The $1.8 trillion market shock. The pulse of the global market just skipped a beat. Last week, the world's combined equity markets experienced a staggering $1.8 trillion swing in paper wealth within a single 48-hour window. This volatile gyration was triggered as structural inflation fears collided head-on with an artificial intelligence capital expenditure boom. 2. Why the market pulse skipped beat. During the week of May 25, 2026, global markets face intense pressure. Sticky structural inflation, escalating geopolitical tensions in the Middle East, and a surging manufacturing sector have forced central banks to signal that interest rates will remain higher for longer, driving investors out of speculative assets and into defensive, cash-rich strongholds. 3. The Great 11 Sector Divergence. This macro anxiety fractured U.S. sector movements last week, sparking intense divergence across all 11 main stock sectors. Utilities up, surged on massive power demand from artificial intelligence data centers. Healthcare up, lifted by regulatory tailwinds and breakthrough oncology therapeutic approvals. Real estate up, rebounded sharply as long-term institutional buyers hunt distressed bargains. Materials up, higher commodity prices drove gains amid persistent global supply constraints. Financials up, higher for longer interest rates continued boosting net interest margins significantly. Industrials up, tempered growth as rising transport costs weighed on manufacturing margins. Energy up, moderate gains supported by geopolitical risk premiums in crude oil. Technology up, mixed results as semiconductor surges faced broader software valuation compression. Consumer cyclical up, muted performance as high borrowing costs choked automotive demand. Communication services down, slipped due to regulatory tech scrutiny and advertising spending pullbacks. Consumer defensive down, dragged down by eroding pricing power against cash-strapped consumers. Hit that subscribe button to be more informed. 4. Deep dive on mega-cap giants. Amid this landscape, specific mega-cap giants are positioned to move upward across key global exchanges. United States, Nvidia, monetizing exponential sovereign AI infrastructure demand. Risk factor, high valuation multiples vulnerable to supply chain bottlenecks. AstraZeneca, U.S. approval of Datoway secures first-line oncology dominance. Risk factor, regulatory drug pricing pressures eroding long-term margins. United Kingdom, Shell, elevated Brent crude prices generate massive free cash flow. Risk factor, volatile Middle East conflicts disrupting maritime supply lanes. HSBC Holdings, European rate retention boosts structural banking profit margins. Risk factor, rising corporate loan defaults from prolonged high rates. Europe, ASML Holding, monopolistic lithography demand accelerates alongside global fab expansions. Risk factor, strict export restrictions limiting critical Chinese market revenues. SAP, high-margin enterprise cloud migrations outpace economic downturn fears. Risk factor, integration delays across complex legacy software platforms. Japan, Toyota Motor, weak yen maximizes record-breaking export revenue conversions. Risk factor, rising raw material import costs compressing domestic margins. Sony Group, strong entertainment content demand offsets electronic hardware slowing. Risk factor, intense competition in next-generation image sensor technologies. 5. Current global conditions. Global decoupling. Current global conditions reveal a stark geographic divergence. While U.S. indexes hover near records, European growth forecasts are being cut to 0.9% due to energy shocks. The U.K. rides a commodity-driven rebound, and Japan grapples with a historic currency decoupling as global funds chase its deeply discounted corporate assets. 6. Here at the Stock Market Performance Playlist is this week's stock terminology learner. What is driving investors out of speculative assets and into defensive, cash-rich strongholds? Persistent inflation, rising global interest rates, and Middle East geopolitical conflicts are driving investors out of speculative assets, like AI growth stocks and crypto, into defensive, cash-rich strongholds, like U.S. Treasuries, energy, and healthcare. Current market example. As of May 25, 2026, this rotation is highly visible. The catalyst, a recent U.S. Treasury rout has pushed the benchmark 10-year note yield well above 4.5%. This is driven by accelerating inflation expectations, with U.S. core PCE flashing red, and prolonged geopolitical friction surrounding the war with Iran. The shift, as Federal Reserve officials discuss raising interest rates rather than cutting them, the rising cost of capital is draining momentum from high multiple speculative sectors. Capital is actively repositioning into high-yielding U.S. Treasuries, energy, heavily supported by supply risks in the Strait of Hormuz, and defensive value/healthcare stocks that offer scalable models and durable, resilient cash flows. Leave in the comments what term you want defined in the next video. 7. The week ahead, macro hurdles. Looking ahead, the upcoming week is critical. Investors await the U.S. core PC inflation gauge, the Fed's preferred metric, along with flash CPI data from Germany and France. Any upside surprise will solidify hawkish monetary policy, while corporate earnings from Salesforce, Costco, and Dell will test the true resilience of global corporate spending. 8. Call to action. Community posts poll question. Where are you moving your capital as the market rotates this week? What are your thoughts? Let me know in the comments below. And if you found this analysis valuable, please give this video a thumbs up, subscribe to the channel for more in-depth market insights, and hit that notification bell so you don't miss our future updates. Your engagement helps us bring you more content like this. Legal disclaimer. We are not financial advisors. Past performance is not indicative of future results. All strategies and investments involve a risk of loss. If you want to cut through the noise and get analysis without the sensationalism, I'll see you in the next video. Farewell.
This is the stock market performance playlist, the sound of victory.